Hi everyone, and welcome to BRC-A's Buying Power webinar series again. Today we will be discussing the latest in renewable energy contracting strategies as we approach 2030 and beyond. Today, as always, we are joined by some fantastic panelists, industry experts, and each of these wonderful people are going to share insights on the market. And what you can do if you're looking at renewable energy contracting now. What are some of the options? So we'll start, as always, with a little bit of an update on what we're doing at BRC-A, what we've done recently, and what's coming up. Following this, we'll have the panel discussion, and I'll introduce the panelists. And of course, today's session, as always, will be recorded for the benefit of those who are unable to attend today, and it will form part of our knowledge bank located on our website under training and events. We will also have time at the end for questions. We will certainly try to have time for questions at the end of the session. So feel free to pop your questions into the chat, the Q&A, not the chat. And we will seek to answer some of those as we go along. So everyone, thank you for joining us today. And I'd like to acknowledge the people of the, sorry, my brain has got too much in it today. I'd like to acknowledge the traditional custodians of the lands on which we're meeting today. And also the traditional custodians of the lands on which you're all based today as well. Please feel free to share in the Q&A where you're joining us from. We're here in Sydney, so it's the Gadigal people of the Eora Nation. So BRC-A, just in case you're new to BRC-A, we have been supporting organisations to procure renewable energy since 2018, supported by government and non-government participants. And we have a whole lot of information, training, templates and guides, and other information at our website. So if you are new, please feel free to jump on and take a look. You're also very welcome to reach out to us if you have any specific questions. So what have we been doing and what's coming up? So most recently we were at All Energy. We had a fantastic session. Another wonderful panel joined us there as we presented our State of the PPA Market Report for 2025. That's the preliminary report that we always launch in October. And we will be launching the final version of that in January once the year ends and we have all of the final PPAs that have come in at the end there. We've delivered a couple of boot camps and also training sessions in New South Wales and Queensland this year, which has been fantastic. We had sort of record participation from Queensland businesses earlier this year in May. And we will also be looking to deliver another boot camp in early 2026, and that will likely be in Melbourne. So keep an eye out for that. We'll be letting people know when that's coming up. We also launched a guide, just switching to the next slide there, Bridget, and that is the Renewable Energy Power Purchasing Agreements in Queensland. So this is particularly of interest to those buyers who are looking to purchase in Queensland. It steps buyers through the key specific issues that you'll be dealing with when building the case for contracting in Queensland. A few unique issues such as the network charges, depending on which zone your assets lie in. Also standing offer arrangements and how they work and how you might compare these with PPAs for contracting there. And then just finally, before I hand over, we have also commenced a national PPA buyers group facilitation program. And we're helping to support organisations, particularly large energy users, but also medium and small, across a new program. We are looking to seek funding for this, but it's particularly focused on helping organisations really push to meet, or in fact, ideally exceed those renewable energy purchasing goals or net zero goals they may have. So we're hoping to commence this in 2026. We're hearing a lot from organisations looking at joining this type of initiative. We won't be providing energy consultancy advice. That will be done by the energy consultants, and same with legal. We will be really focusing on facilitating and bringing groups together across different industry sectors. So great. So now back to our panel. And the reason you've joined today, which is to understand how to take control of your energy contracting. As we reported in our preliminary State of the PPA Market Report for 2025 last week at All Energy in Melbourne, it was that for the second year in a row, we've really seen more very large PPAs executed by a few of the larger energy users and participants in the market. But fewer large to medium PPAs. So that's sort of next step down. However, we are hearing that the tide is turning following market signals and pricing changes. And it may be a somewhat different picture by the time we publish this 2025 report in January next year, with more parties coming back to the market now. So I'm going to pass on the moderator's microphone very shortly to Anita Stadler, who many of you will know. She is renewable energy sector and energy markets expert and partner at ERM Energetics. She'll be helping us to understand a bit more about the evolving market. And Anita will be joined by our wonderful panel today. So our panel today, so we have Mariette Bernard, who is Business Development Manager at Iberdrola Australia, and has many years' experience in electricity management and contract negotiations. And before Iberdrola, some of you may know Mariette from Energetics and Schneider Electric, where she helped many customers with their renewable energy strategy. We have Susie Retchenko, General Manager of Customer at SEC Victoria. And Susie's also highly experienced. She has worked in the energy sector for more than 18 years, with experience across retail electricity, commercial and industrial markets, innovation, business development, technology, and distributed energy. So a lot there. A lot of experience and expertise there. We'll be hearing from Susie. And then we also have Dan Smith, who is Vice President of Commercial at Smartest Energy, and Smartest Energy in Australia, which is a global independent energy retailer backed by the Japanese trading house Marubeni. That facilitates renewable generators and commercial and industrial customers coming together through various financial and physical contract structures. And Dan leads that group. So I won't go on any further. I'm going to hand over to Anita. Anita, hopefully you're ready and available and ready to pose the questions. Thanks, Anita.
Fantastic, Jackie. Thank you very much. I'm going to start off with a couple of slides first before I turn to the panel, and really just share with you. I think this webinar came about when a number of corporate buyers started talking to me, saying, you know, we've got current PPAs. We've been out of the market for some time. 2030 is approaching. We sort of feel like we need a kind of a bit of a update on where the market is at, to just help us to navigate how we deal with some of the changes in the market that has occurred in the last while. So this obviously is a very big topic, and we're definitely not going to touch too much on different kind of contract models. You'll see there's a lot of retailers here on the panel, obviously, today. It doesn't mean that we're not talking to the wholesale kind of contracting market and financial PPAs more broadly. It is all part of solutions that is converging increasingly, and obviously we looking forward to some of the questions that you would be able to put to the panel later on. But I think specifically I just want to sort of touch a little bit on the status quo, look at the factors shaping the next 3 to 10 years, and how the renewables contracting market is busy responding to those very signals, and then obviously with the panel exploring some of those themes. I want to start off with looking at where we are actually in the national electricity market, and just using New South Wales as an example, but similar themes are playing out right across the market. Looking back, I would like to sort of talk about 3 periods really. I would say the pre-2017 period, when before Hazelwood closed in Victoria, the period prior to 2022, where we know the market got suspended and due to extreme volatility. Pre-2017, very little renewables in the mix. Pricing, as you can see in that period, was, and I'm not going to explain this very complex chart in detail, but the green line is really spot prices, and the black dots is the quarterly futures market prices, with the horizontal lines, before I start, referring really to the actual prices that was traded on the futures market for delivery of electricity within that particular quarter. So it's not implied prices, it's actual traded prices, and the gray bar just sort of giving you a sense of the 25th and 75th percentiles. But really what I was trying to point out is that prior to Hazelwood closure, we had a very stable and boring electricity market, probably for many traders. Once Hazelwood closed, you could see that even in New South Wales, which is an adjacent market and connected and influenced by what happens in Victoria, you had the whole spot market prices actually moving up. That green line shifted up, and it stayed up until COVID, effectively, when demand started dropping. Importantly, suddenly the futures market prices started, the range of prices that future delivery started trading on started increasing, because the market got spooked a little bit. How is this going to react? Now you're starting to get increased renewables coming into the mix, which in itself is obviously a variable a variable source. But we are starting to see much more kind of coal outages as the plants are aging. And so historically, we actually had Q1 being a very, very highly priced. Now we've got so much solar in the system, we don't have Q1 being impacted that much by the extreme weather events. It's getting impacted, of course. We're still having outages, and we're having lower wind conditions sometimes in Q2. And suddenly, where people were trying to time the market in the past, the signals on the market, there's just not a pattern that you can think that you could actually time and beat the market in contracting. What also is what I want to call out here on this chart in particular is that the moment there's a disruption that drives up spot market prices in terms of supply and demand, the futures market, which is what drives a lot of the retail electricity supply contracts, gets spooked and typically trades out at higher premia for a good 18 months thereafter. We have now seen a period that you can say, yeah, the spread of that grey boxes is sort of becoming a little bit narrower. Maybe the volatility in the futures market is sort of not as extreme as it's been. The question really is what lies ahead, and I think that are some of the questions we're getting from our customers. Should we actually kind of, while the market looks fairly sort of moderately priced at the moment, should we act now? Will renewables get cheaper? When should we actually contract? What should we wait for prices to fall further? And I think I just want to talk through some of the key drivers here. which is we've been talking about closure of coal-fired power stations for quite a long time. There's obviously in the news right now a lot of talk around the potential extension of some of these coal-fired generators like veering, as well as Yallourn in Victoria. We've had the Queensland government very recently pull back on a commitment to close all its coal-fired stations owned by it by 2035 to extend their lives again. What I would like to call out is the fact that, and this is this chart on the right-hand side, that people should not fall into a false sense of comfort, thinking that coal is sticking around for longer, therefore prices will drop. There's a physical correlation between the age of a coal-fired power station and its unavailability. They tend to break down, and the way in which they're having to be operated to deal with the variability of supply within the market put increasing strain on them. So coal-fired stations that stays open for longer, the expectation is that, yes, more supply, lower prices. However, that may not eventuate unless there's significant new capital investment in these coal-fired generators, because we would find that they would, as they get older, become more unreliable, and therefore unexpected unavailability will drive further volatility. So if we go back, this is exactly what has caused these big ranges within the futures market, is when we're having unexpected outages from coal generators, coupled with increased variable renewables, it drives up a risk premium. So do not fall into a sense of false security, thinking that pricing is going to come down because coal is sticking around. Volatility, in our view, is here to stay. For those of you that's waiting to see, should we wait to contract for renewables because the price of the capital cost of new developments has increased? There's good news and bad news. I think if you're looking at just a simple diagram from the CSIRO, storage and renewable and solar cost has started moderating. Unfortunately, wind is still pretty pricey. Yes, it may moderate, but I think whereas a while ago people would have been reluctant to contract with solar due to this price suppression in the middle of the day. Combinations of hybrid solar and storage has become very compelling alternative considerations as well in terms of wind. Is therefore not the only option available, I think, for the market to consider if you are interested in contracting for financial PPA or a hybrid structured product. And I think increasingly there's also a preference by some of the larger customers for more predictable shapes, which obviously a combination of wind and solar and storage can actually support that. It makes it easier for them to take control of their own kind of hedge books that probably in the past would not have been that possible. So really thinking about some of the larger users taking on increasing risk, but utilizing a diversity of technologies to do so. We've also seen some buyers coming back into the market, given the significant price drop, of course, for that's available in LGCs. Bad news for developers, but it's good news for corporate buyers. And we're seeing retailers passing through these lower prices to customers. And with the introduction, obviously, of regos on 3 November, there's alternative choices available as well. And so whereas the green premium was extremely high in the past, it's actually not that significant at the moment. And really, if you want to contract long and manage your energy transition risk, there isn't really many other options available than renewables. It's about how firm your supply requirements are, and obviously what risk you can take in that regard. But going long and going green has become much more of a risk management strategy rather than a pure sustainability strategy. I think why I'm talking so much about shapes and firmness, I think there is obviously the wind and solar. The more you get supply from the same shape coming into the market at the same time, you will get price suppression. We can see that, however, there's once you get more storage into the system, and you can see that busy happening on solar, the curve, the discount relative to the time-weighted average prices are starting to flatten out. And we can see that as there's more arbitrage and storage in the market, that some of that will reverse. However, it's the variability of wind and solar that is partly driving some of the volatility that we're seeing even on the futures market starting to become more prevalent, coupled with coal outages, as we said. So there's definitely, from both retailers as well as corporates, how do you actually manage a load that is when you're starting to introduce so much variability in your underlying hedging instruments, i.e. your source of electrons. If there's variability in it, how do you manage that risk exposure? And this is a message really for a lot of the developers on this market. If you're not moving up the value chain and starting to think about how you can participate in a market that is increasingly valuing capacity and firmness, I think you're gonna find that at a very competitive market for run of plant output. So really a message to everyone that yes, corporates and retailers are both looking for instruments and ways in which to manage the exposure to some of this volatility. But I think what this chart on the right also showing is that whereas we're seeing significant price suppression prevailing for some time in the middle of the day, it will start kind of becoming less extreme as we get more storage into the mix. I think I'm not going to be able to cover all the themes, but I think to just summarize, and I've just sort of jumped on the web and say what is the themes that's really been hitting buyers on a day-to-day basis virtually, and this is just October, and all of the themes virtually suggest that there's significant headwinds in new supply coming into the market. Whether it is because offshore wind is deemed less favorable, whether snowy is being delayed, whether there's planning approvals processes that's causing delays. There's talk, obviously, of some of the larger energy users struggling to kind of deal with the increased prices in renewables. Whether there will be government support or not, that time will tell. But clearly what you can see here is that generally on the supply side, there's obviously the NEM review is ongoing, a possible support to close what's often referred to as a tenor gap that may support increased supply. Will hopefully bring better risk management instruments suitable for a market dominated by renewables to the market. But really, I think the important thing is that you look then at the demand side. The data center loads coming on, potential electrification of transport. I think if you look at any of these, the directionality of all of these arrows at the moment for the next 3 years to 5 years to the period beyond 2030, there isn't a lot of signals that says there's going to be a crash in prices. In actual fact, it says yes, tightness in supply is still a concern because there is some headwinds that needs to be addressed, and demand continuing to remain strong. Jackie mentioned that there's been a lot of big deals, and Rio Tinto clearly has dominated the market in the last while. But if you look at where the market is at, there's a fair bit of activity coming back into the market. There's probably what I'm showing in 2025. We've got deals that we've actually supported that have not yet announced. We're expecting probably before the end of this year, another 840 gigawatts just from ERM facilitated transactions to be announced, which will make 2025 a fairly significant year in terms of volume. There's obviously other players in the market other than energetics. We do have competition, and I'm sure they've got deals that they've worked on that's not been announced as yet. So it's not that everybody is sitting and doing nothing. There's definitely a lot of corporates, and especially in the big end of town, that has taken charge of their own destiny and started contracting. And it's not only front of meter, there's a significant behind the meter activities happening as well to help to manage their own loads, to make their own loads more attractive for renewables shaped electricity prices. So the key thing, though, is that if you're thinking about what types of contracts and is out in the market, and one of the reasons why we've got retailers here today is we have noticed, as Jackie said, there's a lot of the big end of town is still comfortable contracting for financial PPAs. The middle market as definitely what we've seen. If we take Rio out of the equation here, we've definitely since 2021, only 21% of what was contracted in the market has been for run-of-plant renewables. Either if there was a CFD, a run-of-plant contracted, they tended to have been a battery included in some instances. Otherwise, retail intermediated PPAs have sort of surged in interest for this middle market, which is why I would like to explore how the retailers' models and approaches is also shifting to accommodate some of these changes that we are seeing, and looking at the headwinds that may be ahead. I think the important thing last point I want to make before I turn to the panel is be aware that a lot of corporates has had 2025 targets, and of course have concluded those transactions. Some of them have deferred their obligations. Others has not necessarily announced it. But key here to note is that a lot of when the red ends, there is going to be a lot of wholesale PPAs entered into by retailers coming off contract, of course, because a lot of them had contracted for meeting their compliance obligation. They will need to potentially recontract, obviously, to meet their customer load hedging requirements. But there's after 2025, the concentration of commitments is typically around 2030. So that period, 2028 to 2030, I think will be a very active time in the market from a contracting kind of perspective. And I think it's also important to think about how do you actually get yourself probably not sort of to contract either beyond or prior to those periods, because I think it will be quite a challenging time in the market. So that is all from me at this stage before I'm turning to the panel. Thank you very much for dealing with this little bit of a technical overview, I suppose, of the market, and I hope you found it interesting, and I'm happy to take questions as we go along. But I think I would like to turn to the panel at this stage. And really, I think let's stick on timing for a little bit. So if I go to Mariette first on this particular one. If you have got a 2030 target as a buyer, or you've got a PPA, and it's coming off between now and 2030, what would you recommend they consider in terms of engaging the market at this stage?
For sure. Thanks, Anita. An excellent presentation as usual. A couple of things I would mention. First one, I would say be careful of complacency. So my advice would be to budget appropriately and realistically. And just to explain that by an example, we recently came across a customer that contracted a PPA back in 2020 when electricity prices were low. But when their stakeholders saw the electricity prices offered in the tender, they were absolutely shocked. So the customer did not budget appropriately for the increase in market prices, even though it was clear as day that pricing wasn't going to return to where they'd contracted 5 years earlier. So the changes in the electricity market shouldn't shock your stakeholders. So keep them abreast of how the prices have changed and what could potentially happen for your next contract. Another thing I would mention is that with the large number of PPAs you pointed out that are expiring between 28 and 2030, it's going to be the Hunger Games of securing a quality project. So many companies are looking for projects younger than 15 years of age. So with that current PPAs expiring and those with 2030 targets hitting the market and the retailers hitting the market trying to find PPAs around the same time, you are going to struggle to find a quality younger project if you leave that too late. Just general advice, give yourself at least a year to work through a procurement process. Those processes do take long. And anyway, you're really just increasing your time to market risk by waiting until the last minute to procure. Agree with you on the LGCs. So LGCs are the lowest that we've seen that pricing since the start of the LRET. There's lots of merchant projects coming into the market every week to dump their LGCs that they haven't been able to contract under a PPA. So there is an oversupply. So currently there's more of an upside risk than downside gain. And then lastly, just as you also pointed out, Anita, be careful of there's no magic bullet that will decrease electricity prices to what they were back in 2020. If you consider just the impact of CPI and what gas prices have on electricity prices, as well as those increases in finance and supply chain costs for new projects, those are now baked into those projects. So that's enough to know the pricing just won't go back. So in our view, agree with you that this pricing environment is our new normal for the next few years as we work through the renewable transition. It's going to be volatile. Instead, be realistic and proactive to protect your business against risk. That would be my response.
Thank you. Dan, you want to add something to that before I turn to Susie?
Yeah, and also great presentation. Well done, Anita, as always. I kind of get the parallelization of investment decisions right now. Kind of if you're contracting a PPA, you're bridging a lot of regulatory uncertainty post 2030. You're kind of moving through quite an uncharted territory, particularly with coal extensions. It creates quite a different proposition of the value of a PPA right now. And we're all kind of waiting for more flexible assets to come into the grid, which will start to flatten the supply and demand imbalance. And exactly, Hunger Games is exactly what that's kind of causing. I definitely would agree with that analogy. It's kind of forcing a lot of corporates who have committed to renewable energy into what would be like a 2028, 29 window. And if you add into the Hunger Games, the special new guest, if it's the second or third or fourth film, whichever one would be, of data centers, it kind of is going to create quite an intense action movie in that sense. Will there be a scarcity of projects? Yes, probably. And there'll be a scarcity of good quality projects, not just new ones, but ones where you're looking at good kind of resources of solar, wind, the right kind of developer that works with you. But I think about adding a slightly different angle. That period reminds me of a time when I was in the UK in our retail business, where the number of retailers in the UK went up from about 25 to over 100. And the issue that made for us at the time was quality of people, and that everyone was trying to find the same people in the same period of time, and there just wasn't that many. And so finding the right people was a real issue. And if you compound that with, as you said, Anita, a lot of the previous PPAs were run-of-plant PPAs. The next ones aren't likely to be like that. They're going to be more complex. They're going to be solar plus hybrid, or they're going to be slightly different firming structures. There's going to be nuances which people will have to work through, which will take more time. So my advice to anyone right now would be kind of start to try and find your team, work out who they are, work to try and engage with, if you've got a current PPA, also try and talk to other developers, not just necessarily your incumbent, but work out who those people are so you can touch the market early, start engaging, start to build relationships, importantly, with the kind of people you think you might be working with. And have to think about, when it comes to the Hunger Games, are you going to be near the end of the film, or are you going to get killed quite early because you're competing against traders, retailers, larger corporates who might just be a bit more attractive to you or might have been prepared early?
And I think, Dan, you're right. There's definitely been a significant change in a number of actors in the Australian market. We've seen a lot of trading desks coming in as well, which will hopefully help with some of the liquidity of more sophisticated products. But yeah, it's really there's pluses and minuses, and I think start early, I think, is the message I got so far. And know that you probably need to kind of, if you are able to deal with more complexity, all good. Otherwise, find a partner who can actually help you to translate like that. But I think, Susie, do you want to kind of add anything to this?
Yeah. So we sort of, I'm coming at a slightly different angle and don't need to talk about the long-term PPAs because Marriott and Dan, of course, covered that off. So at SCC, we sort of see there's 3 things buyers should think about when they're looking at procurement contracting strategies for retail energy. So those 3 things are renewables, flexibility, and partnerships is the way we see it. So if we look at renewables, obviously, Dan and Marriott have already covered that off, long-term PPAs, purchasing LGCs. That's a given for your grid consumption. The other consideration is generation behind the meter of renewables. So it's, of course, obvious, but planning this now and important to consider that in your procurement decision if you're going to do it in the future. So are you going to install solar, maybe upgrade existing solar, maybe you do waste to energy. Some of our customers do that. Mini hydro, I've got a customer looking at that. And pairing that ideally with battery storage to maximise the value. And of course, if you don't have capital, there's plenty of people out there and retailers that will offer behind the meter PPAs. Some people call it on-site PPAs, where obviously your retailer and other partners own and manage that asset for you and provide the renewable energy as a service. And that's charged on your bill behind the meter, a separate line item on your bill. And of course, because the energy is generated and used behind the meter, there's no network charges. So it's at a lower cost. And that gives you that resilience and management of that risk. The second thing is flexibility. So the question here is how to unlock flexibility in your demand to help manage risk, build resilience, and take advantage of the intermittency of renewables and incorporating that once again into your retail contracting strategy. Traditional contracts, of course, when they're retail anyway, there's penalties for changes to shape and volume, and everybody's familiar with flex clauses. But as the grid and retailers' portfolio shifts to 100% renewable, and at SCC, ours is 100% renewable already, there's significant value in flexibility of customer demand enabled through these behind-the-meter storage or ability to shift your load, matching that to the intermittency of renewables. And this value is significant, especially significant where the asset is controlled or where capacity is committed as part of a retailer's, say, VPP, and the retailer can use that committed flexible demand to help effectively firm intermittent renewables and using it effectively as a hedge and passing that benefit back to the customer. So it's sort of like you almost hedging your own grid consumption. And then the retail contract goes from traditionally not allowing any flex or having those penalties to rewarding flex when it is that committed. And for SCC, this is where we're focusing our product and technology development. We're setting up a VPP and we're focusing on developing those structured renewable retail products, things like multi-period time of use and products that reward flexible demand. The third thing is partnerships. This is sort of obvious as well, but how can you think about how you can partner with your retailer or other market participants on to collaborate, ensure transparency, share risks and benefits, work together on behind-the-meter investments, electrification, energy efficiency. And this is also something we're looking at, how we can provide energy as a service and partner with our customers. Already doing this with some of our Victorian government customers, like water corporations, where we're working them on demand management solutions. So that's renewables, flexibility, and partnerships. So thinking beyond just the grid consumption.
So if I maybe focus just zoning on the flexibility bit a little bit, I think if I understand you correctly, and I think clearly we've started seeing it on ASX as well, where the traditional peak is dropped. We've got morning and afternoon, evening kind of peak products. Most of the end users on this webinar probably still receive a peak and an off-peak tariff from the retailers. I think if I'm hearing you correctly, that kind of flexibility and utilizing behind the meter kind of resources, it doesn't necessarily need to expose the buyers to spot the way you're thinking. It can be changing of tariffs essentially that you're seeing could enhance that. I don't, this is maybe too, because I think often people think about kind of reducing the risk premium that obviously changing. If you're on a peak off-peak tariff, it doesn't help. You've got a battery behind the meter. The difference between the peak and off-peak is so little that it doesn't pay for the battery. But just maybe
exactly. So that's some of the stuff we're thinking through. So one way is simple time of use, 4 or 5 period time of use products where the price in the middle of the day would be lower. So that can encourage that behaviour and reward just by shifting your load to the middle of the day when the prices are lower. So that's one way, and they'd be fixed, so you don't have to take any exposure to spot in that scenario. So it's just having that greater variability in the fixed prices throughout the day, so a broader time of use. And sorry.
Okay, so that's, I think that's sort of clearly one way in which we can kind of you're suggesting there's ways that businesses can take control of the risk, the transition risk, and the premiums that we see coming through in the futures market. If I can maybe then turn to Mariette and see if there is there anything that you think corporates could do to take more control of their destiny in what is an uncertain and unpredictable period that we're entering here.
Yeah, for sure, Anita. So I would say there's no one size fits all approach. So your strategy depends on your risk appetite, your procurement flexibility, and your operational setup. So if I were to categorize customers into 3 broad categories, that would be firstly those who have low tolerance for risk, but with no ability to shift load. Those who have who can take on some more risk for some potential reward, but also no ability to shift load. And then lastly, those who have full operational or full operational flexibility to shift load. So in that first bucket, if you have low tolerance for risk and you can only contract at fixed pricing, I would say consider contracting long term. So we as a business take a strategic view when we price long term, which means that you're able to access more competitive pricing. I certainly know that many customers who locked in renewable supply a few years ago now wish they'd secured longer term certainty, especially given today's pricing environment. And then in that second bucket, if you're able to take on a bit more risk and you're able to procure progressively, you can consider locking in a portion of your load long term under fixed pricing. And then the balance of your load can be progressively purchased. So one example would be a customer contracting long-term for 70% of their volume on fixed pricing, and then the remaining 30% of their volume is progressively purchased. So that provides them some certainty in the fixed block, but the ability to take advantage of temporary reductions in market prices under the progressive purchasing. But just mentioning, a customer can actually choose what portion of the load they want to fix, what portion they want to be exposed to progressive purchasing, so 50-50, 60-40. So that's all determined in the contract up front. And then lastly, you've got that customer that is able to shift some or all of their load. So in other words, you've got some operational flexibility. So Susie's already kind of touched on some of that, and that's great to hear, because those custom products are now emerging that reward you for that flexibility. So for example, you can have a custom time of use definition that allow you to benefit from super low daytime prices if you're able to shift load away from that expensive evening peak. Some other products may reduce fixed pricing if you're able to turn down operations when spot prices are above certain levels. So that, for example, is a customer that can take on a bit more risk. So those are just a couple of examples. If you're exploring that kind of flexible procurement or load shifting options, we'd be happy to walk through what's emerging and tailor something for your needs, because that very much needs that kind of tailoring. So that would be my broad advice. Anita?
Excellent. Dan, I'm going to give you a chance to kind of speak to this kind of topic of how to take control, but I want to rope in a question that's coming from the audience as well at the same time, which I think has got synergies with your with probably your response. what it may be, but they're asking, how can large corporates manage/reduce risk premiums in long-term contracts when all players in the market, including energy retailers, are aware that there's expected volatility in the next decade due to plant closures and transition in general? So this is really about, yes, we know this is a challenging time ahead. We're saying that you need to take control. There's other. Can you add other strategies and tactics that you think large users could consider in addition to what Susie and Mariette has sort of alluded to?
Yeah, it's making me think of an analogy. There's a guy at the bottom of my street who's not even 30 probably, and he bought Bitcoin many years ago. And that was great for him. And I would also like to make the perfect investment. But if I ask my financial advisor now, what should I do? And they either said, just buy Bitcoin now for everything or do nothing at all, I'd probably find a new financial advisor. And there's probably a little bit like if you had, you've got a renewable commitment, your CFO doesn't want you to do nothing now. And my answer to that is probably the market's the market. Like everything's priced in. There's no one who hasn't got sophisticated modeling who's working through these things. So we can only price what's in front of us, and the value of a PPA is the value of the project to a large extent. So I think I would look at it as kind of look at like an investment portfolio in that sense. Like you want to kind of build in diversity, you still want to do something. And like Mariette was saying, you can do like a partial hedge. And if you're talking to probably larger corporates with this answer, you could kind of create diversity across technology, tenor, geography, and that structure of the contracts. And the bigger the demand, the probably more diversity that's warranted. You could structure splitting wind and solar is an obvious one, where you kind of reduce the basis risk between what the supply of the portfolio is compared to your demand. That's a logical thing to do. And I think it was mentioned earlier, you could think about the different tenor of your contract. So take a longer term PPA where you've got a better implied discount to a long-term curve, which covers your stable load, the thing you're confident of, and then maybe take shorter term, either market prices or short-term PPAs, where you give yourself some operational flexibility that you need, but and can also follow the changes of technology, because prices will change. You don't have to lock everything in straight away. We've done that with a corporate where they, didn't want to necessarily be tied to one counterparty for a very long time. They did their own financial PPA, and we were able to work with them to manage the parts they didn't want to, and incorporate that as a value hedge into their retail contracts. They can still bring in other PPAs at a later date of their discretion, or they can buy at market through us. So there's ways of disconnecting things to make sure you can still act now. And really, there's no perfect financial investor, and I wish we could go back in time and buy Bitcoin 15 years ago, wherever it came out. But that's just not reality, right? You've kind of got to do something and think about it and break it up and create diversity. It's the logical thing to do, if not mathematically.
And so what you're obviously saying, for large energy users, it's probably easier to diversify because they can, over tenor, over contract types, over technologies, over and pricing models. But to some extent, for more medium-sized corporates, I think as a retailer, as a risk manager, can actually help to construct some of those solutions. You as an intermediary, I think that's really a role, would you say, for retailers going forward, to actually make some of those more sophisticated products, I would hope, more accessible, and being the translator, I suppose, and warehouse that some of that risk over time, I suppose. For there's no risk, as nobody's going to take risk on your behalf for free, but you can manage that, I suppose, differently. Would that be fair to say?
Yeah, definitely. There's some things which retailers are just better placed to do, kind of managing settlements, warehousing, shape risk, smoothing cash flows, all those kind of things where we're set up to do that on a larger scale. So it makes sense to put the right things that belong with a retailer. And in reality, what we're trying to do is simplify the complex bits that operationally a corporate or sometimes a developer aren't set up for.
Mm-hmm. And so much more of an seeing an active risk management role for retailers in their interface with customers, I suppose, is what I take from that. But Susie, if I can turn to you, is there any given the challenges that we're seeing ahead, how do you see the role of the retailer evolve further from beyond risk manager? What other views have you got?
Yeah, I mean, I'll just starting, I just wanted to make a comment on the risk management, because I think it is about how retailers can make it simple and easy to understand renewables and that risk. And I feel there's a role of the retailer in terms of reducing that risk premium, that ability to effectively recalibrate your shape to the renewable portfolio. And I actually think everybody can do this. It's about unlocking that flexibility. Some people say, I don't have flexibility. You do, if you look at, and we're helping customers today by assessing their site for storage behind the meter. You don't have to have capital. You can work with the retailer can own it, and then you can recalibrate your shape, and that will reduce the shape premiums in particular and produce cap premiums and things like that, because the retailer can use your flexible demand as a cap. So that's how, to me, reducing that premium, it's the retailer still manages it for you, but in partnership with that flexible demand, it can actually significantly help reduce the premiums. And that's what we're trying to come up with, simple products, how you can integrate that flexibility into the retail offering. So that's probably one thing retailers can do, is try and make that complexity simple for customers through simpler structured products. Second thing I think is education, and education's key in particular for smaller organisations who perhaps don't always have that risk capability or that knowledge. So retailers can play a role in that. And at SCC, we're looking at ways we do that. That's part of our purpose as a government-owned organisation. We're doing that. We're already talking to a lot of our customers and helping them with their transition plans and giving them education on the wholesale market and how to manage that. And I think the third thing is around data and visibility of data and digital solutions to help customers understand and manage their own risk as well. So I know lots of retailers have portals. We have a portal that we think is pretty good that we get from our vendor, real access to that metadata, ready access graphs and insights and things like that. Through the portal, we're looking at load disaggregation to help with efficiency and things like that, that once again can help you to better manage your energy use, shift load, lower prices overall. So working in partnership with retailers, and retailers providing that education and learning and making it simple.
Before I hand over to Chris to wrap up, one last question for Mariette, and I'm going to go with one of the themes that seems to be emerging from questions from the audience again here. And no surprise, REGO post 2030, what that may mean for pricing, and the other one, if you could touch on very briefly, how important is additionality these days? So if you can just maybe comment on those two before Chris, I think I'll probably hand over to you to conclude.
Yeah, sure. We definitely find that corporates are still very much focusing on LGCs until 2030 and having that REGOs in the post-2030 world. We've had a number of customers now contract right throughout that period. So we'll transition from LGCs to whatever that future ring product, which will be likely REGOs, what that will transition to. So we have taken a view on price on REGOs post 2030. As to me sharing that, I won't be. But I think a part of you would say, given that there's no mandatory scheme in there, it should, in theory, have less, more supply, less demand from that perspective. But yeah, there's definitely some customers taking a view on that now and rather securing something that they're comfortable with at this point in time. In terms of additionality, obviously, if you're contracting through a retailer, it's not pure additionality or old school additionality where you're contracting directly with a project. But if you're indirectly helping to add new renewables to the grid, which is something that you are doing when you're supporting a retailer that is consistently developing new renewable projects, then that's what you're doing. So we, for example, we take a long-term contract and that helps us to go and build new projects. So indirectly, there is some additionality that you can sort of claim by doing it in that way. hopefully that's answered your question, Anita.
Yeah, and I think just on additionality, I suppose my 2 cents was, I think the standards being imposed by leadership organizations like the RE100, I think still attaches a fair bit of value to that, in terms of making sure at least that it's at the end of a PPA, the plant age kind of requirements, I think imposed kind of suggest that you should look for supporting newer projects. And I think the issue just becomes as well contracting for both electrons and certificates. I think over a decent tenor, I think it's really what the market needs. So 5 years plus, I think 7 years, 10 years. That's obviously where the market would ideally want to be, and I think that's where the NEM review is looking at this kind of market to 7 years is really where most buyers seems to be comfortable with, and I think obviously longer than that it becomes more favorable for developers. They really like 10, 15 years, but it's I think it's working out appropriate pricing models and risk structures to actually support a longer tenor arrangements as well. But I think the longer you go, obviously the more benefit there is for underlying renewable energy investors.
Yeah, correct.
Chris, over to you. I think I'm right on time, funnily enough. Strange for me. Seldom. I'm always 5 minutes late, but
perfect. Oh, I'm going to double read. No, we're all good. Yeah, a couple of minutes left. Thank you. That's a fascinating panel. I think we heard from all the panelists that the market context is pretty challenging, of course. There's a higher level of uncertainty about coal closures and other things that will impact on prices. And so it's easy to understand how people drift a little bit or end up in a bit of paralysis. But I think the clear message from all the panels was not to allow that to happen for several reasons. One, you could find yourself in a bit of a Hunger Games situation as we get closer to 2030, and there's a lot of buyers circling around a dwindling pool of quality projects. Secondly, we're kind of probably moving into a more complex contracting environment, from sort of simple run-of-plant PPAs to ones with more complex structures. And I think we heard from each of the panelists various strategies that can be used to try and manage some of this complexity, particularly in approaching it like an investment portfolio, getting diversity, different types of mixes of fixed versus progressive pricing. There's a range of ways in which I guess retailers and advisors can help buyers try to navigate this tricky environment, but sitting tight and hoping it gets better and hoping you're the Bitcoin investor from 15 years ago is unlikely to be what happens if that were to be the path you choose. So hopefully everyone out there got, I think, lots of interesting ideas and insights from some of the leading retailers and advisors in the market. Apologies to those whose questions we didn't get to. We normally circulate them and provide some further answers as a follow-up. But apart from that, have a great day and a great end of year to everyone, and we will see you in the new year as BRC-A. Thanks everyone for today's participation.
Thank you.